Yeah, I'm John Collins. I'm with a firm called FS Vector. We're based in Washington, D.C., and we work with fintechs and banks on a variety of political, regulatory, and compliance issues. And we have a pretty all-star panel here. I will ask each of them to introduce themselves and their companies, and then we'll get started with the discussion. So, Annie?
Yeah, good morning. My name is Annie Delgado. I'm Chief Compliance Officer at a company called Upstart, which is headquartered actually just down the road in San Mateo. Upstart is an online platform that partners with banks to offer consumer credit products online in a fully automated and digitized manner. The company was founded on the premise that the current construct for credit pricing and underwriting in the United States sort of unfairly leaves a lot of people behind, either by declining them access to credit or offering them rates that are not commensurate with the true risk that they might pose as a prospective customer. And so Upstart's approach to how to solve this problem is to leverage alternative data sets and alternative credit modeling techniques to try to improve access to affordable credit. So obviously this topic is very near and dear to my heart and to Upstart's heart, and we're really excited to have been invited to participate in the panel.
Christian Warner with Kabbage. I head up domestic policy and corporate social responsibility. Kabbage, if you're unfamiliar, is your neighborhood-friendly small business lending provider. We allow small businesses to come onto the platform, quickly underwrite them using non-traditional data, alternative data, and try to get them a loan within 7 to 10 minutes. So we really like to use a non-traditional approach just because we know that traditional FICO model is not necessarily correlated with business success, so we try to open up their access to capital.
I find it interesting you say neighborhood, by the way.
Yeah, we try.
Are you building bricks and mortar we don't know about?
We are not building bricks and mortar, unfortunately.
Oh, sure. Yeah. Hi, everybody. Good morning. I'm Melissa Coide. I am the CEO and founder of FinReg Lab. We are the DC-based organization conducting research in evaluating new types of data and new technologies in financial services. Our purpose is to inform general market practices, but also very importantly, I know this isn't a popular topic out here in California, but to inform policymakers ultimately about how we are going to be evolving our regs and our laws in light of the benefits and also the risks associated with the use of new types of data and technology in the financial system. So it's a pleasure to be here today. Thank you, John, for inviting me.
No, of course. And I want to start with maybe a basic question, which we had a discussion about some possible kind of topics that we wanted to explore. But, when we hear the term alternative data, I guess I wanted to level set on what exactly that means. We know alternative music is an alternative to, I guess, music, but what is alternative? What is alternative data an alternative to, and why are we having a panel on it? Why is it important? Anybody can talk about it, but maybe I'll start with Melissa to start on that.
Yeah, I think that's a really, really important question because it's so darn nebulous, right? I think alternative data typically in most people's minds, policymakers and the market itself is referring in underwriting context to the data that is not basically what constitutes FICO, our traditional credit underwriting method for evaluating credit risk. Alternative data may range from the things that we have evaluated in this cash flow experiment that I'm going to talk about with you all, where it is true financial information that is gleaned from a bank account or a prepaid card account, all the way to a variety of other types of data, whether it's geolocation information, literally the cadence of somebody's thumbprints as they're typing. I mean, in my mind, it's basically anything outside of what we think about that creates a FICO score. But would others agree or disagree? I actually wasn't on the prep call, so I'm not quite sure what they said about this topic.
I would agree with that. It's commonly just anything that you can't glean from a credit report. And I think broadly, I hear people sort of divided into two categories of like user collected data versus third party collected data. And obviously those have different practical implications of how they can be used, whether they're used in credit underwriting or sort of more fraud and verification type context because of FCRA concerns. But generally that's kind of what I hear adopted as the two broad categories.
I would agree. I think it's especially for us, we deals solely with small businesses. So what's interesting is that small business owners create a tremendous amount of data, and it's generally stored in one or two places, right? We don't see small business owners changing their bank account every year, right? So we can get an incredible amount of history and data just from cash flows. But we also incorporate other types of things, both for fraud and for in the underwriting context. For example, we look at a small business's Facebook profile for the fraud. It's incredibly hard to recreate a fake small business Facebook profile for their business, right? To judge and see how many times they're interacting with their customers, how often they interact with them, how fast they interact with them. It's just not worth the time for a fraud person to go through and do that. And on the other side of underwriting, we can actually see, we can use UPS shipping data to see how often they're shipping, what they're shipping, volume of goods, movement of goods, things of that nature. So we can kind of see there's a lot of cadence, especially for some of our mom and pop shops who ship, beads for jewelry out, every day. Like, we can see that they're constantly shipping, and that we can also kind of look at the health of what the business really is.
And so, okay, I think that's really helpful, at least it was for me. Why, I guess, are we having a panel on it? Why are there panels at every kind of financial services or fintech conference on this? Well, what's so exciting or interesting or different about this approach or this set of information being used that makes it that exciting?
Can I?
Sure,
can I jump
please.
in?
Yeah.
I would also say, this may start to get into our conversation with you all. I think it's one, Annie essentially speaks to there are different expectations and different policies and laws that govern data use for different purposes, clearly in financial services. I would also point out, when we're thinking about alternative data, there's fraud, obviously, but there are also really important opportunities to think about using new types of data for even things like, are you who you say you are under your Know Your Customer obligations? Right now, the industry, especially in the U.S., is pretty stymied and stuck on what is essentially a safe harbor, where you can rely on a Social Security card as a form of identification, government-issued ID. Some of what we're looking at FinReg Lab and want to dig into deeper is, do some of those other types of data, geospatial information, mobile device information, actually help a financial firm evaluate somebody for, are you who you say you are? I think there's real promise and opportunity, but how we might think about the laws and expectations around data use for identification might importantly different for how we think about what are the types of data we're using for something like credit underwriting. So I think we'll dig into that a little more. Why we are so focused on data and technology is because even just in the credit space, we have between 40 and 60 million people in this country who lack sufficient credit history under traditional means of evaluation to get them into safe and affordable credit. And so that was actually what drove our evaluation of looking at financial data out of a bank account and really assessing, does that data enable a lender to evaluate a customer, a thin file or a no file customer, whom they otherwise might have turned down. But should I talk about that more, or would you like me to save that? But I think this, to answer your question, John, this opportunity for leveraging data, both for bringing more people into the financial system who traditional means typically have kept out, for lots of reasons, more recent sort of credit or a longer term credit ding that may still be showing up vis-a-vis the traditional FICO score, where more recent information that you can see from somebody's bank transaction activities really does tell you the potential health that they're in right now and perhaps can prudently handle credit. I think those are some of the opportunities that looking at non-traditional data or alternative data present.
Yeah, I'll take I agree with everything that Melissa said, but also just sort of stepping back to like, why is this exciting? I think we're really just at the beginning of learning all the ways in which this is exciting. We hear statistics thrown out there like 90% of the world's data was made available in the last 5 years or was generated in the last 5 years. And when you think about how much our lives have changed in the last 5 years because of this data, it's really staggering to think, okay, well, in 1 year, 5 years, 10 years down the line, how much more is our lives going to change? I know, practical things in less regulated industries, like my interactions with Netflix have vastly changed because of data in a really great way. Wouldn't it be great if we can bring that same type of revolution to people's experience with their financial institutions, with their banks? And so I think the questions that financial institutions should be asking themselves in terms of how to use this data, that really the exciting questions to be asking is, how can I use this data to improve my customers' lives? Melissa touched on some of these things: better pricing outcomes, better approval rates, less onerous application processing, more tailored and customized experience in the servicing life cycle of a loan. There's just so many applications that are already being used and available today, and I bet there's going to be 100 more in the next 5 or 10 years that we haven't even thought of yet, because more and more data will become available every day.
I think for us at Kabbage, we always want to try to meet the small business owner where they're at. I think if you were to go talk to anybody who handles cash flow management, whether it's the CFO of JP Morgan, or whether it's the co-owner of the mom and pop shop that has of a dog walking shop, they all care about cash flow. It all keeps them up at night, and to be able to use a product where they can log on and manage cash flow. We're launching a product that'll just be kind of like a mint product, like for small businesses, to really look at cash flow and to see that data projected over 12, 18, 24 months, and to know where the traps are. I think starts to allow them to get a little more sleep at night, allow them to get back to why they started that business. No one started their small business to manage cash flow, right? You started to own your own bakery, to make cakes, make people happy. So I think really looking at it, putting it back onto the customer, giving them the ability to use that data for good for their own lives is something that we kind of take very close to heart.
So I want to touch on something that Melissa actually referenced, which is, on identity, because I want to unpack that a little bit from the perspective of what is the future. We talked a lot about so far kind of how it's currently being used, what sort of data is currently being used, and what for. But from your organization's perspective, what is the future there? What future sources of data might be used or useful? What specific projects or products might be offered based on these new models? I guess just where are we going from here?
So I don't think I can comment on future products or services.
You don't want to announce any products today?
I don't want to announce any products today. But I will say that Upstart has invested really heavily in building a best-in-class data science team. We have a really solid team of smart experts that are constantly sort of looking for other data sources and doing a lot of studies about how these data sources might be useful to our customers. And so there's, in any given day, sort of research lab type of conversations going on in our data science group to talk about what we might be able to do for our customers in the future. So I think that there's a lot of exciting stuff that's on the horizon. And then I would also say, just in terms of how it's used sort of today, we do use some of these data sets already in things like verification processes. This allows about 70% of the loans that are funded through the Upstart platform are funded in an instant approval cycle, which means that the customer enters their basic information in an online rate check form. We run a credit report. We're able to verify the information we need to verify through third-party data sources without actually asking the borrower to upload any supporting documentations that would further delay their processing speed. And so the 70% of loan applications that go through this fully automated experience get from start to finish in roughly 15, 20 minutes. And if you think about that in context of what it's like to actually, get dressed, go down to your bank, sit there in front of a loan officer, fill out a bunch of information, maybe bring back supporting documents, it's a vastly different experience. So a lot of that stuff that we kind of talk about hypothetically is in practice today by Upstart and by others as well.
I think for us, I do have a product to announce. We just launched payments yesterday, so we're very hungry for that data, right? We're excited to know that we now will have swipes, invoice kind of data that is coming just directly into the Kabbage model. we're also really looking at, as I mentioned earlier, modeling cash flow for our small business customers, really taking that tool, something that every Fortune 500 CEO or CFO has the ability to model. The small business owner just doesn't have that time or that capability. So really looking at the ability to project cash flows for them. And then third, I think, is also something interesting we're working on is how we view their money at rest and versus money in movement. So really looking at, we're building out a deposits product here that will also be there. But what are we doing with their cash at hand, right? So if you're, I think most savvy consumers, if you're really up to speed, you have some savings in a high yield savings account, you've got your IRA, you've got all these different places, and it's working for you. A lot of small business owners don't do that, and so if we can figure out a way to really kind of treat that money in a safe way, how we view it as it's coming in to your business, what it's doing at rest, making sure that you're kind of using it in the appropriate manner. I think that's something that we're trying to do. It's a big step for Kabbage, right? But it's something that every small business deserves. And so really focusing on, I think in the future, to answer your question, John, the money at rest is going to be a huge topic for 2020 and beyond. Mm-hmm.
Do you have policy questions on here?
Yes, yeah, absolutely. Yeah.
I'm trying to figure out when to insert these things.
Yeah,
and when
no,
not
for
to.
sure.
Yeah, I mean, I'll just key off a little bit of what you have talked about, Christian, and tell. Are folks in the room familiar at all? I know some of you are. I know some of you with the research that we did. I don't want to be repetitive. Yes, I know you, Peter, know this well. Then let me just tell you a little bit because it starts up a conversation that I think will take us in some important places. We, about a year and a half ago, sought to engage industry to do this evaluation of transaction data, financial data, looking at loan-level information from consumer and small businesses' bank accounts to understand, is that financial information, and I'm emphasizing that for a purpose, is that financial data indicative of risk? And so I want to commend the 6 companies who participated in this research with us because it was bold for them to be a part of this, and Kabbage was one of the companies on the small business side who did this with us. The other companies, so I don't lose anybody, Opportune, and I know Raul is here on the consumer side, Bridget, which is out of New York, which is offering an overdraft alternative but relying on transaction data, Petal, Axion, which is a CDFI, and LendUp. So these companies participated in the research with us. We took in the data, and we hired Charles River Associates, I'm not a data modeler, to look at that data and ask 3 core questions that are important for the market and important for policy. And I see those things as very interrelated. 1, is that data predictive of risk? Are the lenders able to make a determination to extend credit looking at that transaction level data? And the answer there is yes. It is enabling these lenders that are very diverse, by the way, both in their products. Generally, it's small dollar products, although the business loans are obviously larger. But these lenders were able to use that data and make determinations both on consumers and small businesses where there wasn't a traditional credit score, but also on consumers where there was a credit score. And interestingly enough, that cash flow data actually illuminated risk categories within FICO bands where we did have the FICO scores. So that's interesting in and of itself in terms of broader adoption of using this type of alternative data. Secondly, we wanted to know, and I've answered this already, are these lenders able to serve underserved populations? And the answer there is yes, both on the small business side and on the consumer side by a number of different variables, including geographies, zip codes, zip +5. We did see consumers and small businesses were served with the use of the cash flow underwriting. And then the third piece, which is a core question for all of us, and I will caveat, every firm has to do its own disparate impact evaluation, but importantly, what we were able to ask is, are the data independently predicting risk separate from protected class variables or populations? And there we did see the data were independently predicting risk from protected class populations. Thus, the data that we looked at do not indicate a risk of disparate impact. That's a really important factor as we think about these different type of data, and especially if we're using them in the context of underwriting. So that was, really, I think, important. It was valuable. Many of you are probably also familiar with the fact that we had, when's the last time you've seen this, to the extent that you're paying attention, a joint letter by the prudential regulators and the CFPB explicitly stating alternative data may not be risky, and in particular, they call out cash flow data as a type of data that may help lenders extend credit to underserved populations. I'd like to think that we were helpful as they were contemplating whether or not they would take that kind of a step. We are about to release the policy report, which really starts to get in some of these really important thorny questions around data access. Most of you in the room know this type of data that we're talking about is typically consumer permission data. There are a lot of pressing questions about what constitutes meaningful consumer permission. There are a lot of important questions about what are the accuracy obligations and on the different entities that are a part of that data flow process. There are a lot of market competition issues that you will see us talk about in our report that we think are stymieing the evolution and the adoption of cash flow data because there are concerns often by the data holders, i.e. the depositories, in terms of what data is able to flow. So these are all issues that, frankly, I think does require, in some cases, clearly industry engagement, and there have been a number of comprehensive data industry efforts to start to solve, especially some of the technical issues. But we also are going to be coming out and making the case that it probably is time for the regulators to begin to really hone in on things like 1033, which is a section of Dodd-Frank which specifically contemplates consumer control over data. And then in the case of data for underwriting, there are protections in the traditional data world that come under the Fair Credit Reporting Act. What are we going to do? This is an important question for all of us, but also the regulators and, frankly, Congress, to think about how are we evolving the protections that we get under the Fair Credit Reporting Act if we're not going to whole cloth adopt FCRA in the context of new alternative data and underwriting. What is that evolution going to look like? So we're going to talk about some of those pieces too. So I hope I didn't jump the gun.
No.
to
That's
sort of
actually a
give the
perfect
full
segue, because
picture.
I was going to get into a policy thing, and actually I want to do a quick follow-up. You've spent nearly your entire career, at Treasury and in other places.
I'm not going to have the answer to this question.
Focus on the policy. No, this is your own. This is just like from Melissa Coide's perspective. Before you went into this work, I'm just personally interested, and you are now at the end of it. Were you surprised by anything? Was there anything that when you approached it initially, as you guys pulled this data together, you were like,
Yeah.
oh, wow, I did not expect
Yeah.
this necessarily?
We did expect the data would be predictive. It is just timely, rich information. And there are lags in what you will get out of FICO that we can see much more timely information through transaction level bank account information. I wasn't sure about the third question that we were asking, the disparate impact question. I also will, and we will always say, any lender needs to do its own evaluation. And you also heard me emphasize, we looked at the financial data, we looked at financial metrics and variables. Those data included things like what are ongoing financial cushions on a monthly basis. There is a lot more information that we all know intimately is in our bank account data. Where do we shop? When do we shop? How much do we spend? And we didn't look at those data. I suspect they are also probably at some level predictive, but I think there just a hunch, I would think we would start to see some potential questions around correlation of that data with protected class issues. So
More than a hunch.
we haven't done the research. We're setting out to do this very empirically, but yes,
Yeah.
Christian, yeah.
And maybe just a quick follow-up, maybe a bit of a tangent for you both, in terms of obviously we talk about data in terms of selling products to consumers or businesses and making sure the products are the right fit based on some of the data. But when they're actually living with the product, and I'll just ask something very specific. If you have a borrower who pays on time and is a good customer, how are we ensuring that is being reflected in FICO or in sort of traditional ways in which we think about good customers or borrowers? How are we accounting for that?
Well, accounting for that in FICO is, obviously we have to, everybody should be reporting information to the credit bureau so that it can be accounted for in FICO. But I think there is a lot of issues with, obviously we know there's issues with data integrity of what's getting furnished to the CRAs. There's also issues with just data completion. Some companies report, some companies don't report. The companies that don't report often tend to be the types of credit products that are available to, more economically disadvantaged groups. So there's problems there. And so I think that the key from my point of view is that when evaluating a credit application, looking at one dimension, a credit score, or two dimensions, a credit score and a DTI, is never going to give you a rich enough data set to understand the person that's applying for a loan. You have to be seeking alternative data sets, and you have to be seeking it in responsible ways, asking the exact questions that Melissa and her team asked in the research of, is this data predictive of risk, and is this data discriminatory? And really coming up with a mechanism and a construct that your company thinks about that it tests for that and measures the impact of what you're doing on an ongoing basis. I think those are the exact critical conversations that need to be had. But the concern or the thing that all of us need to just be aware of is that the old regime of using FICO and DTI is not meeting the mark. It's not good enough anymore. We need to do better. And the way we do better is by learning more about our customers using the data that we have available.
Yeah, I don't think you could say it better.
Okay.
Nice. And now I do have a...
To be fair,
Yeah.
to be fair though, to the FICO crowd, they have been building. In fact, it's not. I'm forgetting the name of it. It's not Boost. It's the other one, Ultra FICO. They are right now out there piloting with a number of companies, I believe, an evaluation of FICO that is FICO combined with cash flow data. And they're finding very similar indications of it is more timely, it's richer, it's more indicative of risk. And they're going through the pilot process right now. So it's not to say that they also themselves don't realize, it's time to think about how we're evolving. And then we all saw the news last week about FICO 10T. Where they're getting richer in terms of how they're evaluating different products and how consumers are using those products. So I think we're all sort of moving into space of, seeing that there is the need for the industry to catch up.
Yeah.
And how do we do that in a way that is safe?
That's right.
Anything else on that?
I think just going back to what you were saying earlier, the open banking issue, and I'll put a name to it, I think that's something that will, again, define not only this year, but certainly the next 2 or 3 years. Especially in Cabbage's space, post-Great Recession, most banks have pulled out of the lending that Cabbage works with, or the small business that Cabbage works with. We fundamentally believe that everyone here, you, I, own our data, right? Just because it's in a bank account doesn't mean that it's not your data. And so the ability for us to ingest that data, to read that data in a meaningful way, will come to define the next couple of years. I think a couple of years ago it was always like, it was banks versus fintechs, and then we kind of realized it was really more like banks and fintechs. But I think there might be another evolution to kind of see how we can work together while still using the same set of data. That's part of the reason why we're pushing into, we're looking at deposits, but also we need that data, we need that ingestion. And so if we get, data that gets disrupted, in the worst case scenario, we saw that with PNC and Venmo, all of a sudden people realize that they have the ability to shop their data around. That's critically important.
And actually, it's a really good segue to the next thing I was going to ask, which is a policy related issue, which
Sorry.
no, this is great. I mean, I'm a policy person. Last week, the Bank for International Settlements, which I'm sure all of you read all of the reports that come out.
They're very good.
Yeah, they're
I
actually
didn't read this one, so I don't know where we're going.
out of Basel essentially they did a survey of 30 governments around the world to see what they were doing related to fintech policy, and then segmented it out based on some of what they're doing and how they're perceiving different fintech developments into what they called a fintech tree. And it's actually, they made an illustration of a tree, which had 3 layers. One was fintech activities, which is, what's actually being offered, lending, et cetera. And then there was a middle part, which I can't remember. And then there was a third piece, the root, which are policy enablers. And one of those that they listed was open banking. And the idea there is it's going to, something that's going to continue to impact financial services and enable new financial services activities that perhaps were not available before. And so they listed this as something that people were paying attention to, concerned with, and they offered a few warnings, I guess, to the industry and to some of their member governments about it. And the 2 notable ones were the increasing reliance on third parties and what risks and challenges that might present. And the second was a challenge that they see in terms of overcoming the lack of harmonized standards and interoperability of these enabling technologies. So the first piece of that, for maybe the industry folks, and then I'm going to ask you on the second piece, the third-party risks that open banking or any of this presents, how do you view those risks? How do you address and mitigate them? And then the second piece, I'll ask you, Melissa.
So there's a lot of different potential answers to that question, and just because it's a pretty complex question. But I think for Upstart's primary sort of role in the marketplace is as a third party for banks. So I'll channel the challenges I hear from my bank partners all the time, and what I hear from my bank partners most frequently is that the biggest sort of risk or challenge that they face in partnering with a company like Upstart to bring, these products to their customers is the regulatory uncertainty, specifically around model risk management and fair lending. And I'll use fair lending as an example because I'm a compliance officer and it's near and dear to my heart. And also, as I mentioned, what sort of gets Upstart employees up in the morning and makes them want to go to work and build things. So the regs do a great job of sort of defining categories of data that we can't use. It's a pretty short list of data that we can't use. And it says, very briefly, you can conduct a self-test. There's not a lot of information about how to conduct a self-test, how to think about that self-test, what's an appropriate metric to be measuring against, what are appropriate sort of thresholds or, of risk. What is enough of a correlation of 2 things to make it a proxy versus not? That's not something that's actually answered anywhere. And we all know that there are significant sort of discriminatory effects in things like FICO or income, but those have somehow been kind of grandfathered in as acceptable, where the new things are still items that cause people pause and worry. And so the banks are left with this sort of challenging situation where they're saying, we know that there's discriminatory effects with what we are using today, but our examiner's okay with it. So, is it safer just to keep status quo, or should we try to, move the needle here? And so really sort of developing a little bit more regulatory guidance or clarity about fair lending testing is something that I think is important and definitely I would support. And it's something that Upstart, obviously, as probably everyone in this room knows, has put a lot of effort into sort of building and developing in the context of our no action letter conversations with the Bureau, and really, from the inception of our company, has been part of the mechanisms built into our compliance program. So,
yeah, I think for us, we've been heavily involved in the open banking debate, both here and in Canada. It's one of those things where it's kind of dominated discussion in Europe, less so here. I think it's starting to heat up a little bit. Traditional financial institutions have kind of woken up, I'll say, over the last maybe year and a half, to kind of say, there are some risks with this, right? We are a third-party provider. At the same time, and I'll say it again, we fundamentally believe that you own your own data. You should be able to move it and shop it around. There's tremendous cost benefits for consumers and for small businesses in their ability to move and shop their data, to get good deals, to use, and glean insights into their own data. So obviously there's risks, right? I mean, there's anytime you are plugging into someone else's system, there are fundamental technical risks. At the same time, I think to not move forward, to shut that off, and I think, to kind of close it off would be a real loss for the U.S., right? Like, I mean, we are, I don't use the falling behind analogy, but I think there's a sense that there are other parts of the world who are doing this much better, much faster, much cleaner. If you look at Singapore, look at the UK, when it comes to open banking, and Canada that just passed it a couple months ago, I think personally it's time for the regulators to step in and kind of help consumers out. So this isn't, we don't have breakdowns in the system that's already kind of moving forward.
Yeah, and Melissa, welcome to address that question, but really from your perspective, I'm interested in the warning regarding the lack of harmonized standards and regulatory approaches across the world, maybe even within the U.S. And what's the future there, and how do we reconcile that? I guess.
Well, I'm going to say something somewhat general that will just sort of key off of what you're asking. There is no question that the impetus for data privacy is hitting the U.S., and we're grappling at the state level. California obviously has its law. Other states are adopting their own, and I think most of us would agree there's value in thinking about something at the federal level for lots of reasons, for privacy purposes, but also harmonization purposes. In California is, as I understand it, although it does sound like it's a bit of a piece in motion, it does recognize data in the context used by financial institutions gets a carve out. The thing that I think that we really have to push ourselves to think through, and I tend to be probably very narrow in how I think we need to evaluate these things, is the financial system is based on risk mitigation. Risk mitigation is based on information, which is based on data. And we need to be able to risk mitigate in the financial system. We need data. And there are clearly risks of sort of rampant data access, data use without meaningful consent. There are also potential losses if we don't allow new types of data to be used in the financial system. And so my inclination is, let's really push ourselves to evaluate different types of data even in different contexts in the financial system. Do we want to think about, privacy protections and expectations for data with respect to, are you who you say you are, in the same way that we think about the obligations of data that are used in credit underwriting? Let's sort of build our thoughtful evaluation of data use in the financial system, and then how does that then reconcile or not with a more generalized data privacy law? What we're not talking about that I think probably is on the horizon is if we go through a downturn, when we go through a downturn. And now we're talking about the potential of data for servicing all the way through to collections. The type of information that we're talking about today is really rich and really personal, and could be used for harm in a collections process. And it could also be used, I would argue, for good. But we don't have laws that think about and govern sufficiently how this new type of data is going to be used in those circumstances. So that's another sort of applied area where I think some real thoughtful research and evaluation would be to everybody's benefit, to make sure that we are going to be evolving our laws, whether they are at the state level or at the federal level where we are focused, in such a way so that the benefits of the data are for good and they are both beneficial to the consumer, the end user, as well as the provider.
You guys have any thoughts?
Yeah, I totally agree with that statement, and maybe jumping the gun to something we might talk about later. But I think that it's going to be exciting to see how policy evolves in some of these types of issues. But also, it's going to be impossible for policy to keep up with every single possible thing that technology is going to come up with. And so, one of the things that I think is just critical and crucial for the technology industry is to make sure that they are employing a diverse set of personnel to be making the decisions about how their technologies are built at all levels in the organization, so that within a company there is a responsibility to be having conversations not just about what's possible from a legal standpoint, but also what should be happening from a consumer standpoint. And I think we'll see policymakers and regulators take approaches there, but I think companies also need to be having those conversations internally, and it really starts by having the right people at the table and a diverse group of people at the table to have those conversations.
Yeah, I mean, I think that'll be that. So, my other hat that I wear is diversity inclusion, and I think that's we're based in Atlanta. We bear this burden more so than anybody else. We are the city that's too busy to hate. It's important, right? I mean, I could show stories of we were looking at cash and the importance of cash, and we paid a consultancy to tell us that inevitably people still use cash. And I could have told you that it took me 4 months to convince my barber to get Venmo. It's just that simple. People love cash. Certain segments love cash. But the fact of the matter is, we could have had that conversation in 10 minutes over lunch. Didn't need to have McKinsey come in and tell us that. So I think there's simple things that have been things that there are growing pains. As Kabbage gets bigger, we have to get more diverse. We have to start, we lend to a third of our customers are women or minority small business owners. We need more women. We need more women of color. I've been very passionate about pushing for this because it's kind of it's in tech. We see this issue. Frankly, if you look at this room right now, we see this issue. We need to have more diverse voices at the table. It's important, and because the products that are coming out affect not just one demographic. They cross cut.
Yeah, and actually, maybe we can just drill down on that a little bit more. There's that old, I guess it's old now, the PayPal Kiva study that showed about sort of some of those lending products and how they were actually being utilized, at greater rates by minority-owned businesses and women-owned businesses than perhaps traditional financial services. Obviously, when we talk about these macro issues of financial inclusion and access, what is, we talked a little bit around this, but what is the actual role of our alternative data in that, and how do we use it and construct it in such a way that it's actually, reaching and furthering those, social goals, either from the company perspective and how you guys, think about it. And I think you touched on that in terms of constructing, a team of people that can think through that. But, interested in how you guys think about that, and you personally with your role at Kabbage. And ask Melissa.
Yeah, I mean, I think it's the fact of the matter is we purport to say, and I'm thinking as how it's Black History Month, I love how the fact that our product's blind. We like to use alternative data, but I was reading an article that was produced by the Fed, Sears, and it's so sad they're going out of business, but they launched back in the 1900s. They launched the first catalog, right? And they could send it out to wherever you were, and you could actually fill it out, right, and send it back in. You could get your flour or your grain or your seeds if you're a farmer at a lower cost than the general store down the street. But what's also interesting is that some of those prices were inflated at the general store because they were black borrowers, right? It really was the first kind of blind use case for credit. And so I think it's interesting to say that they've launched this article ahead of Black History Month. But I think it's important to say that we need to have these products cross-cut. They affect everybody. There's a tremendous amount of responsibility to help lift people up. We purport to say that fintech does this, but I think that it needs to be a sense that we're checking and making sure everyone's coming up, right? Everyone is involved. We're not just kind of segmenting one section. And I think that's what we try to do at Kabbage. We love that it's blind. We love using alternative data so that everyone has a chance, a fair shot at getting in. We definitely look at FICO, but we definitely discount it a little bit because we know that your dental record from 2 years ago has nothing to do with your pizza shop, right? And so that's really important, and I kind of applaud all of us up here for using it and affecting and moving this conversation forward. over the last couple of years.
Yeah, if I could just jump in really quickly too, and I talked about it a little bit earlier, but I just will continue to say over and over every chance that I get that the key to understanding what your model is doing is testing, rigorous testing, statistical testing. And so making sure that you have a construct in place at your institution to be constantly digging into your data and understanding the effects that it's having in terms of who's coming to get access to your products, who's actually being given access to your products, and then what pricing they're being offered. And so digging into that data on a regular and ongoing basis is really important. We do it quarterly. We also do every year we have metrics that we're testing to see how are we expanding access to credit relative to a traditional model, right? There's certain benchmarks that we want to hit in that area. We're really proud of the fact that our last sort of study on this was published by the CFPB, and it showed that we're expanding access. We're able to approve 27% more applications relative to a traditional model at 16% lower APRs, and that holds true across all sort of groups that are tested that we're able to proxy for and understand. And so having systems in place to do that testing and in a rigorous, statistically sound manner is just, it's key to understanding what your model is doing, and every financial institution should be taking strides to improve their fair lending testing.
Yeah,
and access to credit testing.
I think the point on testing is good, and I have some people in Iowa who you might want to talk to about testing various things. But Melissa, I don't know if you want to follow up on that.
We talk about this in the report, and we're doing this. We're a not-for-profit research organization, and we think there are some things that it's important to recognize and to be said, and so we're saying them, and I'll say them here too. Data reflects economic circumstances. It reflects where people are coming from. It reflects their families, their communities, and we have a history of differences in populations, wage differences between males and females. And as we are talking about bringing in new data, the reality is we are probably going to see that reflected, a variety of differences, races, genders, et cetera, in the data we use. Now, what's interesting and I think really important is in our fair lending laws, we have a multi-pronged process for evaluating what data we in the end decide stays in or not. We also have explicit laws that say you cannot use protected class data. And I do hear it would be helpful if there was more guidance around when data are proxying or correlating. But I think we also have to just own the fact that we have these historical differences. We don't like them. We want to see things change. And I'm wearing my old Treasury hat here, where I spent a lot of time focused on financing higher education. There are a lot of other important policy levers that we have to start pulling to get greater equality between race, between genders, and the list goes on. And I think we have to keep that in mind too, that it is this push-pull. We do have some important protections. I want to flag something. I'm not sure if this is what you were talking about, Christian, but anyway, that's a point that I just want to make, and we call that out in the report. We may see on average differences between men and women when we do the initial prong one evaluation under fair lending laws. Then you would move into the business case rationale and you would evaluate, is that reasonable business case rationale or not? That is a process that exists. But we still don't like it. But again, where are the policies we're going to make those changes? One other thing, though, that I want to flag, Carol Evans at the Fed, head of consumer compliance, released a compliance publication. It's probably got a proper title, I'm not remembering. But a couple of weeks ago, and what she has said, which I think is quite interesting, especially in California, is you regulated depositories. You were essentially on notice when you were relying on third parties for advertising or marketing who may be using new types of data for deciding who you are marketing to or targeting your products to, that you need to understand what are the algorithms, how that is explainable, what those algorithms are, and what the outputs are of those algorithms are. because you are on the hook. You are obliged to make sure that we're not seeing discriminatory patterns or practices when you're relying on those third parties. I think that's really an important sort of pay attention note that Carol and the team at the Fed are sending as we are increasingly seeing even our regulated entities beginning to think about bringing in new types of data, even on the front end in terms of what products are being marketed to which population. So I just call that out to take a look at if you get a chance.
That's a big step, and it's a big step that our marketing team is kind of. We've been, as a policy person inside of a tech company, we're like constantly like, yes, we have to, like, there are rules and laws, very strict laws around what you can
There's
do.
less supervision on this.
Exactly, and so
But yes, there are.
And I think that's key, especially at a tech company, that there are barriers, there are boundaries that are there, and they're there for a reason.
Yeah.
Well, I think we could probably talk about this all morning, but I know you guys want to have lunch. So, and I think I'm getting the hook from Phil. So please give a hand for our awesome panel up here.